The stock market is currently closed for the weekend, and looking back at the last live session on Friday, May 15, 2026, BigBear.ai Holdings Inc., trading under the ticker symbol BBAI on the New York Stock Exchange, finished the day at $4.14 per share, marking a minor intraday decline of 1.66% during regular hours. While a slight drop like that might seem standard for a volatile small-cap player, what most retail investors are completely missing is the underlying structural shift happening right now under the surface. While the broader public is hypnotized by massive tech giants like the Nvidia stock and the absolute monster valuation of Apple stock, smart institutional money is quietly filtering down into specialized microcaps that lock down massive federal defense backlogs. BigBear.ai just cleared a huge hurdle by locking down over $60 million in new national security and FAA contracts, proving that, while its headline revenue growth looked flat, its contracted backlog is expanding. This creates an immediate mismatch between what the casual trader sees on a basic chart and what sophisticated funds are evaluating on an institutional individual brokerage. The expectation out there in the retail trading landscape is simple and flawed. People see the massive hype around consumer-facing technology and assume that every single firm with an artificial intelligence label should be scaling at parabolic rates, putting up massive, flawless margins from day one. Investors log into their retail accounts, whether they are managing their own long-term funds through platforms like Schwab Intelligent Portfolios or taking a self-investing approach with tools like the Robinhood app, and they expect immediate gratification. When they look at BigBear.ai, the expectation is that it should be behaving like a typical software-as-a-service provider, but the reality is far more complex, gritty, and heavily tied to the slow, bureaucratic gears of government procurement. If you treat this company like a mainstream software provider, your expectations will consistently fall short. However, if you look at it through the lens of a mission-critical defense contractor that is integrating proprietary analytical intelligence into battlefield infrastructure, the reality completely shifts. The general public tends to abandon these names when a single quarterly report shows a minor dip in immediate revenue, which is exactly why a contrarian view is required here to understand if the massive short interest, which recently climbed near 30% of the entire float, is a trap or a justified warning sign. Let's look at the intense trading activity and the recent daily swings we've been seeing on the public markets. Over the last several sessions, BBAI has been a favorite target for automated trading systems and algorithmic signal groups, frequently finding itself grouped alongside highly volatile tech plays in specialized watch lists. During the last live trading window, the stock opened up at $4.23 and bounced inside a tight but active intraday range between $4.10 and $4.27, showing a significant amount of active hands shifting positions. When you analyze the trading volume, it hit roughly 18.5 million shares for the session, which shows intense liquidity and localized focus for a company sitting at a $1.57 billion market capitalization. Even though the stock has felt a heavy amount of downward pressure since the start of the calendar year, losing roughly 19% of its value year to date, it is still holding on to a 13.5% gain over the past 12 months relative to its multi-month lows. The technical setups tell an incredibly detailed story of a multi-directional battleground. Right now, the stock is trading comfortably above its 50-day moving average of $3.80, which short-term bulls are trying to establish a firm floor, but it remains heavily suppressed under its longer-term 200-day moving average of $5.43. This structural gap is exactly why Wall Street analysts are completely split down the middle on where this entity goes next, resulting in a fractured consensus where some see a massive 33% upside toward a $5.50 price target, while others are aggressively shorting the equity into the ground. If you are currently executing your own online investing or seeking active investment help through specialized analytical dashboards, you have likely noticed that the broader sector momentum is highly fragmented. While negacap names carry the indexes, small-cap intelligence providers are forced to fight tooth and nail for every ounce of capital. For BigBear.ai, the institutional sentiment is an absolute battleground. The massive short interest of 29.58% means that a significant portion of the market is actively betting on an absolute operational failure, creating a high-tension coiled spring environment where any sudden positive macroeconomic shift or unexpected federal award can spark massive short covering rallies. We saw a glimpse of this dynamic earlier in the week when optimism surrounding expanding defense frameworks caused a sudden 4% intraday pop, proving that this equity reacts violently to contract news. Meanwhile, when you look at insider behavior over the past 6 months, top-level executives have been trimming their positions rather than buying on the open market, with notable six-figure sales from insiders like Pamela Joyce Braden and smaller liquidations from Chief Financial Officer Sean Raymond Ricker. For an investor utilizing premium execution pipelines like Interactive Brokers Trading or tracking institutional fund flows on a high-tier Interactive Brokers platform, these mixed signals require an immense amount of discipline to filter out. It raises the critical question of whether the underlying contract execution can outrun the natural burning of capital that all consulting-heavy tech firms experience. Comment below how many shares of BigBear.ai you currently hold in your portfolio right now, and let me know if you are actively buying this dip or sitting on the sidelines.
To understand why this gap between expectation and reality exists, we have to look directly at what this enterprise actually does, its core business model, and how it generated its current market position. Founded originally back in 1988 and operating with a heavily restructured footprint out of McLean, Virginia, BigBear.ai does not build generic mass-market chat applications or creative image generators. Instead, they operate in highly secure, high-consequence decision environments where data chaos can literally be a matter of life and death. Their primary business model revolves around selling sophisticated decision intelligence software, advanced data engineering pipelines, and custom machine learning frameworks directly to the United States Department of Defense, the broader intelligence community, Homeland Security, and specialized civilian organizations like the Federal Aviation Administration. They essentially act as a highly technical bridge between raw, messy, fragmented data streams and operational commanders who need actionable clarity in real time. For instance, their supply chain and logistics divisions utilize a system called data conflation at scale, which allows global entities to track vast inventories and run predictive simulations to optimize shipping routes under active threat conditions. Furthermore, their cyber-physical security segments focus on machine-accelerated binary analysis and vulnerability testing for incredibly sensitive military infrastructure. By acquiring tactical entities like Pangium, they have also deeply integrated themselves into digital identity markets, biometrics, and international border security workflows, creating a highly defended moat that standard commercial software companies simply cannot touch with extensive security clearances. However, when you pull up a comprehensive mobile application, whether you are scanning the markets via the Fidelity mobile app or executing technical screens on the main Robinhood stock trading dashboard, the older financial reports highlight why the market remains so cautious. In their first quarter financials for 2026, the company posted quarterly revenues of $34.4 million. This actually represented a minor fractional decline of 0.93% compared to the exact same period from the previous year. For the average individual retail trader looking for explosive tech growth, a flat year-over-year revenue line looks like a massive red flag. This is exactly where the retail expectation fails to align with institutional reality. In government contracting, headline revenue figures are lagging indicators. They only reflect money that has already been cleared, processed, and recognized through completed project milestones. The true leading indicator for a business of this nature is its contracted backlog and its total addressable pipeline. In that exact same first quarter report, management successfully demonstrated a major expansion in their backlog, driven heavily by over $60 million in freshly minted national security contracts and expanding operational footprints with the FAA. This means the future revenue pipeline is actively being secured, even if the current backward-looking income statement looks stagnant to a casual observer using basic investing sites. This structural reality is why your choice of financial infrastructure and long-term strategy matters immensely when navigating these types of positions. An investor utilizing self-investing accounts or setting up automated strategies through a SoFi robo-advisor needs to realize that small-cap defense technology operates on completely different multi-year cycles than standard consumer tech. When people set up a basic online investment or build out a diverse portfolio using automated tools like an intelligent portfolio, they are often chasing smooth, linear growth curves. But an asset like BBAI behaves much more like a traditional defense contractor, characterized by long periods of lumpy cash flows, extensive trial phases, and sudden, massive contract awards that can instantly redefine the corporate valuation. If you are executing trades via a Fidelity brokerage account or managing your retirement capital through specialized Fidelity IRAs, you have to look beyond the immediate quarterly noise and evaluate whether the firm is successfully expanding its footprint within major agencies or losing ground to massive systems integrators. The integration of specialized platforms like their Ask Sage system, which provides a highly secure generative AI environment tailored specifically for thousands of government teams across the country, shows that they are successfully finding high-margin niches where generic commercial models are completely barred from entry due to strict federal compliance laws. Looking forward toward the future outlook, the ultimate trajectory for BigBear.ai will come down to a high-stakes race between operational execution and capital preservation. There are two distinct, realistic scenarios that could unfold over the coming quarters, and both tie directly back to our core theme of expectation versus reality. In the bullish scenario, the company successfully converts its massive, newly secured $60 million contract backlog into high-margin, recognized revenue ahead of schedule, proving to Wall Street that its transition from a low-margin service consultancy to a scalable software provider is actually working. If they can achieve sustained profitability and clear their remaining operational hurdles, the current 29% short interest could trigger an absolute institutional panic, forcing rapid buying that could easily push the stock back up toward its historical averages and reward long-term contrarian investors who executed their entries through advanced platforms like interactive broker stock trading. Conversely, the bearish scenario cannot be ignored. If the company faces extended delays in government appropriations, or if the integration of their recent biometrics and digital identity acquisitions drags down their operating cash flows, the revenue line will remain flat, forcing them to potentially dilute shareholders or take on expensive debt. This would validate the short sellers who are aggressively betting on a prolonged downward trend, causing the equity to test its absolute historical lows. When you take a step back and look at the entire macroeconomic landscape, the tension between what the public expects from artificial intelligence and what a company like BigBear.ai actually delivers is the defining factor for this stock. Casual observers will continue to look at basic daily swings, log out of their Robinhood Investments app, and complain about flat revenue lines. But the deeper, authoritative reality is that this business is systematically building an infrastructure moat within the most secure, well-funded sectors of the federal government. They are positioning themselves as an indispensable utility for national security, border logistics, and digital identity management. To navigate a high-beta asset like this successfully, you have to discard the superficial market narratives and focus entirely on backlog growth, contract execution, and the structural tension of a heavily shorted cap chart. It is an incredibly high-stakes environment where the casual retail expectation of an overnight tech surge stands in direct contrast to the long-term gritty reality of a specialized defense contractor carving out its territory in the modern security landscape. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.